Ladies and gentlemen, Rick Sharga, Executive VP, Auction.com.
Thank you. Good afternoon, everybody. Nope. Good afternoon, everybody. There you go. Tim promised me a live audience and made me fly in for it, so I want to make sure you're all still really alive. Really very happy to be here. Appreciate the opportunity to talk to all of you. I am the Executive Vice President of Auction.com. We're the largest online real estate marketplace in the world. Sold about $8 billion of residential and commercial real estate last year alone. So if you're not actively using the site to look for properties, or if you haven't thought about maybe using the site to sell properties, I'd encourage you to do so. Check out Auction.com for more information. Prior to joining Auction.com, I spent a couple years with Carrington Holding Company. Some of you might recognize that name. We were very active in the very early stages of the movement to buy properties for the purpose of single-family rentals. Back before everybody was doing it, it was cocktail fodder. The company now actually does a lot of servicing of those properties and property management on a national basis. And prior to that, I spent about 8 years at RealtyTrack, where we published the country's largest database of foreclosure information. So I've been working with investors such as yourselves for a long time now. And I hope some of the comments I'm going to be able to make this afternoon will be useful for what you do throughout the rest of 2014. How many of you came here hoping that I would do an exhaustive, deep dive analysis of all 1,440 pages of the Dodd-Frank legislation? Show of hands. What's wrong with you? I may be one of the 4 people in the country who actually read legislation. As our former House Speaker, Nancy Pelosi, has been quoted as saying, you know, we have to pass these bills so we can read them and find out what's in them. It is a devastatingly boring document. This comes to you from the same people who wrote a report on how to simplify mortgage documentation. It was an 880-page document on how to simplify mortgage documents. So we're going to talk about that today, but I'm going to also talk in a lot of detail, actually, about what's going on in the housing market, what's going on in mortgages in general, what's happening with distressed properties, because I know a lot of you have been looking at distressed properties as a big part of your portfolios over the last few years. We're going to talk about the effect that the Dodd-Frank and the Consumer Finance Protection Bureau's new rules are going to have on the market, what the implications are for investors such as yourselves. Just so I have an idea who I'm talking to here, how many of you are actively buying properties right now? Okay. How many of you are buying residential properties? How many bought 10 or more in the last year or expect to buy 10 or more this year? Okay. And how many of you rent out the properties that you buy? Interesting. Anybody here provide financing for buyers? Very interesting. Okay, good group. So hopefully what we go through today, we're going to go through an awful lot of information in a relatively short period of time. I'd like to save some time at the end for questions and answers so we can interact, so it's not just me talking. I apologize in advance. Somehow my son and daughter caught a cold last week, and you know you're doing a job as a parent if you teach them to share. This seems to be the thing they share best with Dad, and so if I seem a little raspy today, that's what it is. Hopefully the voice will hold out long enough to go. So let's talk about the housing market, where we are and what's going on in housing right now. Still on the road to recovery. This is the longest, windiest road I think anybody's ever seen in terms of a housing market that went south and is coming back. Have any of you ever been to the island of Maui? Anybody ever driven the road to Hana? All right, so the road to Hana is, I think, something like 52 miles, and it's 180,000 curves, and everything's a one-lane road, and traffic's going the wrong. It's a beautiful, beautiful road, but it takes you about 6 hours to do it. And I had the brilliant idea a couple of years ago when we were on vacation to go back the back way of the island, which they tell you not to do, because it's largely a dirt road. Although I was told that it had been improved quite a bit. There's a cliff, a sheer cliff on one side where you can fall hundreds of feet into the ocean to your death, and on the other side there's a mountain that you're running up against. And it's pretty much a one-lane road. I decided to do that at night because I'm a complete idiot. And for a few hours, my kids and my wife basically kept asking the same question. It's like, are we there yet? Actually, it was kind of, where are we? Scariest moment I've ever had on a vacation was going around a curve and hearing all three of them scream at the same time. And what they were screaming at was there was a Ford Taurus on the side of the road that was completely stripped. There was basically the frame of the car. And so my mantra became, don't break down, don't break down, don't break down, don't break down. That's kind of what the housing market recovery has felt like to me. I've been out talking about the housing market really for the last 5 or 6 years and talking about this eventual recovery. And in a lot of ways it was like the road back. But just like when we finally saw signs of civilization on the road back, we are seeing signs of recovery. And all the signs are generally positive. Pending sales are up on a year-over-year basis. Existing sales are up. New home sales are up. Housing starts are way up. Construction spending is up. Prices are rising. Now, these numbers fluctuate a little bit on a month-to-month basis, but generally speaking, if you're talking about the state of the housing market now, it is generally in very positive territory. We had a home price appreciation number last year that's somewhere between 12 and 14%, depending on whose numbers you believe. That's not a sustainable number. We can't do that every year. But home prices are trending in the right direction. Existing home sales, as I mentioned, are increasing. If you see that huge mountain in the middle of this chart, that was the peak. That year we sold over 7 million units in the country, an all-time record. And then we fell off that cliff and dropped down below 4 million. So now we're up around 5.1 million units sold, depending again on whose numbers you're looking at, whether it's the NARs or CoreLogic or whoever's. And it feels better, but if we were really in a healthy housing market, we'd be selling about 6 million properties. So we're still not quite back to where we need to be to look at a more healthy, normal, robust housing market, but it feels a lot better than it did just a couple of years ago when the bottom had fallen out. By the way, if anybody would like a copy of these slides afterwards, just get me a business card or send me an email. I'll be happy to get you a copy of these. One of the primary reasons we've seen prices go up is because there's been a lack of inventory. The inventory levels are starting to come back, but very, very slowly. There's 3 reasons inventory has been unusually low for the last couple of years. One is that there are no new homes out there. You're seeing patches of new homes being built across the country, but way off from the million or so that we saw being built back in '06 and '07. So no new home inventory. We haven't even been building enough new homes to cover replacement needs over the last few years. Second reason is that distressed inventory basically dried up. So not only did we have institutional investors going out trying to gobble up all this inventory, but because of regulatory changes and legislative changes, we've seen a lot of properties that should have gone through foreclosure not actually get into foreclosure. So these properties never made it to the market. And then about 19% of mortgage holders are still upside down on their loans, or at least not far enough in an equity position that they can really afford to sell their properties. So a lot of these people are keeping their homes off the market as well. So really, all 3 types of homes that you would normally see making up inventory are a little lighter than what we would expect. And you know, economics 101, when you have more people looking to buy than you have people looking to sell, prices are going to go up. And that's really what we've been dealing with. The other reason, of course, for price acceleration this past year is that we've seen an abnormally large amount of activity from institutional investors who've been buying up properties in key markets with the sole purpose of holding on to them and turning them into rental units. You folks have been doing this forever. Individual investors, small to medium-sized investment groups have been buying and holding properties and doing it profitably forever. The big guys finally paid attention to what you were doing and decided to come into the market, partly because there was believed to be excess inventory out there they could soak up, partly because there's going to be a huge demand for rental properties for the next few years. I'm one of those people that really believes home ownership rates are going to continue to go down for the next couple of years. And while that happens, we're going to see household formations start back up. So people need a place to live. We've done some extensive research which suggests that most people still prefer to live indoors. So we're going to have more opportunities for rental over the next couple of years. New home sales aren't as bad as they used to be. I used to do some work for Cox Communications back in a past life, and I met the chairman of the board right after he'd won his 4th straight J.D. Powers and Associates award for best customer service, and I congratulated him, and he went, and I said, well, that's kind of an odd response to a congratulatory comment. And I said, what troubles you about this? And he said, who are we competing with for this customer service award? Cable companies and telephone companies. He said, that's kind of like being awarded as the world's tallest midget. He said, it really doesn't make me feel much better. That's kind of where we are in the new home space right now. Again, this is a little bit of one of those chicken and egg situations. There's no new homes being built, so there's no new homes to sell. But the numbers are starting to come back up. We're way, way off where we were at the peak. This is one of the scariest charts, or at least the most obvious charts that we're going to share today. This is new home inventory. And we are right now at a 30-year low in terms of new home inventory. So when you start hearing or reading in the paper about the builders coming back online, breaking ground, this is the hole they've got to dig out of. So we don't necessarily need them to be building 1 million units a year. There really isn't enough market interest to support that right now. But those levels that we're seeing on the right, even with the improvements, are the lowest they've been really since we've been tracking these numbers. So that's how far we have to go back up in the new home space. The good news is that we are starting to see housing starts go up, and this, again, is not a false positive, which is what we were seeing for a while. For a while, we saw housing start numbers go up, and it was only because the builders were building multifamily units. Again, they were banking on rental market being really, really strong, as opposed to the purchase market for owner occupants being strong. But now what we're seeing in both of those categories, the red category and the blue category, single family and multifamily units, are both going up. So again, positive. Construction spending is on the rise across all categories, whether it's commercial, residential, or government. So that's a good thing too. And one of the things I want to emphasize is that all of these numbers are going up in what appear to be sustainable manners. So we're not seeing these huge spikes. We're not seeing spikes that are caused by some sort of bizarre government policy that has people doing things that wouldn't normally be taking place. This all looks pretty organic and pretty sustainable. Home prices are increasing, but the good news is, as home prices have increased and as mortgage rates have gone up, those prices are starting to slow down. I'm going to give you guys some insight that most people don't get, because you don't read about this too much in whatever news sources you're reading. A lot of the increase in price last year came at the low end of the market. And most of the increase in prices last year came in the distressed part of the market. So what you had was Blackstone and Colony and American Homes for Rent and a handful of other big institutional guys running into Phoenix, bidding up the prices on the REO assets that were in the market, getting the prices up to here, and then leaving town. Now, the interesting thing is the prices held when they left. So sales volume has slowed down a little bit, but the prices have kind of stuck. So I'm of the opinion that they accelerated the recovery. They didn't necessarily cause it. But they also didn't cause a bubble, because the prices haven't trickled back down. So if you took out the price appreciation we saw on REO inventory, in really high volume markets like Phoenix, like Southern California, like parts of Northern California, you wouldn't have seen nearly the amount of price increase on a national level as what's been reported. I was talking to the chief economist at CoreLogic about this a couple months ago, and he believes it's probably something more like a 7 or 8% real increase in home prices year over year this past year, but what's being reported is more like 13 or 14%. So again, it's that big difference. We're not seeing huge price increases in the luxury market or even in the middle market. A lot of this was at the lower end, and a lot of that stuff's already baked in. So we're not going to see another 20% increase in Phoenix prices. We're not going to see another 20% increase in Southern California prices this year. And absent that, I'm expecting that this year's home price increases are going to be more like 3 to 5%, which is closer to the historic average, which is somewhere between 3 and 4%. So again, prices are going up. You're going to start reading in the press that those prices are flattening out. That's actually a good thing. And they probably won't dip for the whole year. They probably will wind up going up marginally. That's important for you to know as you're trying to figure out your capital needs for the year. If you're trying to figure out whether this is a year to flip or to hold, you need to be paying attention to those price trends, and that's hopefully some useful information for you as you're doing this. I wanted to throw this part of the conversation in just because I get this question a lot. Are we looking at the formation of another housing bubble? We are not. There's just about no metric that suggests to me that we are looking at a bubble. In the first place, and this is a really nice chart that the folks at Zillow have up on their research center, if you look at what happened with the boom and the bust cycle, and if you look at where the market has come through this recovery, if we were to chart out on average 3.5% annual increase in home prices, which again is about what we've seen historically, and just chart that through what was the boom and bust cycle, what you're actually going to find out is our home prices today are still slightly below where they would have been if we had just gone up on that average basis every year. So we still have a little bit of ways to go to get home prices up to where they would have been if we hadn't gone through that whole boom and bust a few years ago. Secondly, most of the price increases that we've seen over the last year are in markets that basically did fall off a cliff from a pricing perspective. So when you're looking at a market like Phoenix that had maybe a 27% price increase year over year, you have to keep in mind they had a 62% drop from peak to trough. Okay, so you're coming back up off what was just a ridiculously deep fall off. And so it's normal to see a bounce when the market does come back. And homes are still relatively affordable, at least if you look at things historically, and at least if you don't look at markets like San Francisco and San Jose. I think the median price of a home for sale in San Francisco is $850,000. Most people can't afford that. And that's why you're seeing Google buses having eggs thrown at them while they're transporting their employees to San Jose from San Francisco, because the city's gotten completely unaffordable. A two-bedroom apartment in San Francisco goes for $3,200. So the cost of living there has gone completely berserk. But affordability, here's what you have to watch for in affordability. And again, this gets down to your market planning. Are you going to buy more properties to rent because people can't afford to buy yet? Affordability isn't a problem yet. It will be a problem, not because home prices are going up too much, because they're not because interest rates are going up too much. If we're at even 5 or 5.5% interest, we shouldn't be having discussions about whether interest rates are too high. I remember I actually had a mortgage with 2 numbers in front of the decimal point at one point in time, and we were still seeing homes being sold. The problem is wage stagnation. The middle class over the last 6 years has actually seen their median income drop, and overall wages have been flat. So the real issue with affordability is that third thing that nobody ever talks about, it's wages. So it's not the median price, it's not the mortgage rate, it's that wages have not kept up with the increased mortgage prices and with the increased home prices. Credit's also still too tight to create a bubble. What really allowed the bubble to form last time was that if you could fog a mirror, you could get a loan. In fact, if you'd send in a friend who could fog a mirror, you could get a loan. And I actually I was at a conference in Las Vegas when I was at Realty Track, and a guy came up to the booth after, I'm going to guess, 3 or 4 martinis, and said, "You guys are the foreclosure guys, right?" And I said, "Yeah, that's us. We're the foreclosure guys." He said, "If I gave you a list of my seconds, could you tell me who held the firsts?" And I said, "Excuse me?" He worked for a credit union in San Diego, and what they had done was issued second loans to their members without researching anything about the first loans. All they'd done is got an AVM evaluation on what the estimated value of the property they were taking the loan out was, and if the AVM was high enough to support the total amount on the first and the second, they approved the loan. So the wheels came completely off the bus. And by the way, that's why we have the CFPB today. That's why we have qualified mortgage rules today. That's why we have ability to repay rules today. That's why we have a Dodd-Frank initiative today. Because somebody decided it was really important to tell lenders that they shouldn't make loans to people who couldn't afford to pay them back. Did you ever think we need a law telling lenders not to make loans to people who couldn't pay them back? Really? But for about 5 years, everybody seemed to have gone insane. So I guess we really did need that rule after all. So when you're looking at the new rules, the ability to repay rules, one of the things you won't see in the documentation is anything having to do with the value of the house, which is 180 degrees from where we were during the boom. It all came down to home prices during the boom. And as long as prices went up, there were no problems. It's when prices started to go down that the whole house of cards fell apart. But lending standards are incredibly tight. The average FHA loan in 2013 had a FICO score of 700. This is for FHA loans. Okay, they're the government equivalent of subprime. And their average FICO score was 700. For loans that Fannie and Freddie bought, we were in the mid-700s. I think it finally came down to around 750 toward the end of the year, but those are outrageously high FICO scores. So the industry has eliminated virtually all risk from the equation. There are millions of potential borrowers out there who simply can't qualify for a loan, or for whom the lenders really have no interest in issuing a loan because they don't fit within this credit box. So as long as mortgage credit is tight, we're not going to see anything like a bubble forming anytime soon. And the other issue with bubbles, how many of you anybody here is an appraiser? Before I say anything bad about appraisers? Okay, so how many of you have the pleasure of trying to finance something and dealing with an appraiser in your processes? Yeah, okay. Have any of you tried to finance a property, the appraisers come in a little bit under what the amount was? Okay. So as the appraisers have swung from wildly optimistic to this property isn't worth anything, and they really kind of got stuck on that side of the equation, until they start to come back, really does make it hard to finance. Mortgage madness, and I had to throw this in as the subheading. Can't we all just get a loan? No, we can't. So where are we with mortgages? Early payment defaults. The mortgage market, I was talking about how tight it was, how tight credit is. Mortgage loans that have been issued in 2013 have the best early payment defaults ever. What that means is there are fewer people going into default early on these loans in history. So loans issued today are essentially bulletproof. This is one of the reasons the CFPB didn't think it would be a huge jolt when they put new rules in place January 10th, because again, most lenders weren't taking on any risk anyway. And I will give the CFPB some credit. Actually put this in writing in one of the mortgage trade publications. What the CFPB basically did with the QM rules, with the qualified mortgage rules, is they codified what today's lenders were already doing. They didn't overextend more regulation on top of what the lenders were already doing. The lenders had basically eliminated all the risky behavior that had gotten us into this trouble in the first place, And what the CFPB basically did is say, let's take a look at the underwriting practices they have in place, and that's what we're going to issue as regulations. It's not quite that simple. There are still some road bumps along the way. But again, these loans are performing at just ridiculously good rates and across all loan categories. So we had some real problems in the vintage years of 05, 06, 07, a little bit in 08, so that the red bar and the green bar are the two really bad years, 06 and 07. And during those years, the amount of subprime loans written went from about $400 billion a year to about $860 billion a year, and almost all of them seem to have defaulted at one point or another. But if you look at the last 3 years, the performance of the loans has been just spectacular. Nobody's defaulting on these loans. That has some implications for what's available in distressed inventory that we'll talk about in a minute, but I wanted to make that point. And then it is important to note that interest rates are on the rise. Now, there's a couple things to keep in mind here. I believe that one of the reasons we haven't seen more of a return from non-bank lenders or even some of the traditional lenders in being able to lighten up and loosen up the mortgage standards a little bit is because interest rates are too low. What motivation do you have to take on any risk for a 4% note, really, as a lender? You can probably do a lot better putting the money somewhere else without any of the risk or regulatory hassles that you have to deal with. As interest rates go up, you probably will see lending standards loosen up a little bit. It will be a little bit easier for people to get loans that currently can't get them. It will also change the performance of those loans because we're going to be getting more risk back into the marketplace. But something to keep in mind as we go forward. Refinance activity is really what's dropped off the table. So when you're looking at the Mortgage Bankers Association estimating that originations of mortgages are going to drop from $1.75 trillion of mortgages last year to $1.12 trillion this year, which is just an extraordinary drop. All that drop is in refinance. So you had two things that really spiked refinance activity last year. One was the government's HARP program, which made it possible for anybody who had a loan owned by Fannie or Freddie who was underwater but current on their payments to refinance at lower interest rates. They did millions of those loans. The other is that, frankly, as home prices went up, people got to a position where they had enough equity to qualify for a refi, and virtually everybody who could have qualified for a lower price loan did so. As interest rates go up, it's less attractive for people to refinance, makes less sense financially, so you'll see those refi numbers drop off the charts. That's why you're reading about all these layoffs in the mortgage industry right now, is the people who used to do these originations aren't there anymore. Purchase loans are going up marginally, but they're not going to pick up the slack. So they're going up a little bit, but the mortgage industry is in for a rough year this year in terms of loan volume. And then recent demand has weakened. What's kind of an interesting psychological debate is whether loans really are as hard to get as we think, or people have just stopped trying. So when you look at mortgage application volume, most weeks the application volume is going down. Is it because consumers have decided to vote themselves off the island and not even try to get a loan? Or is it just the way the market is set up right now? But it'll be interesting to watch. So the good news with all this is that we're finally toward the end of this foreclosure tsunami we've been living with since 2006. Because those loans of the last 3 years are performing as well as they are, there's virtually nothing new coming into the system in the way of defaults or foreclosures. So the pipeline is finally starting to dry up. That's really important for anybody here who's been looking to buy distressed properties, or who will continue to look at buying distressed properties. There's simply going to be fewer of them. What we're seeing right now in terms of foreclosure activity, foreclosure starts, and this is just kind of an analysis of where we were. So back in 2006, when this whole thing started, there were about 700,000 people that got a foreclosure notice over the course of the year. That peaked in 2010 at about 2.8 million people. In a normal year, with the volume of mortgage activity we have, we'd be looking at about 500,000 people getting a foreclosure notice of some sort over the course of the year. So at the peak of the market, we were almost 6 times higher in terms of foreclosure activity than what we would normally see. Even today, when we're down to about, I guess it was about 1.3 million, 1.4 million last year, we're still looking at numbers that are 2 to 3 times higher than normal. It just feels a lot better because we were at 6, and the industry and the government really couldn't handle the volume. But a lot of what's happening now in terms of foreclosure starts, and that's the orange bar there, or the yellow bar, is that loans that are seriously delinquent, these are people that have not made a payment on their home in 2 to 3 years, those loans are finally now going into foreclosure. And you're seeing this in judicial foreclosure states, states that basically stopped doing foreclosures when the robo-signing scandal hit a couple of years ago, and are just now restarting. So New York, New Jersey, Florida, Illinois, Maryland, Maine, if anybody's from Maine, those are states that we're seeing, Illinois, those are states that we're seeing new foreclosure activity, but they're not really new foreclosures. They're foreclosures that should have happened 2 or 3 years ago. And that pipeline is coming through. California, Nevada, Arizona, Texas, Georgia, other states that didn't have as prohibitive foreclosure laws are probably going to clear through the backlog a lot faster. And in some cases, like California, already have moved through most of that. We're seeing more of a normalized relationship here, by the way, between foreclosure starts and foreclosure completions. When we're finally in recovery, you'll see those 2 columns invert. So you'll see more foreclosure completions than foreclosure starts, because it's taking, in a lot of cases, over a year to do a foreclosure from start to finish. In New York, it takes 1,200 days to actually go from the beginning of a foreclosure to that final sheriff sale. Florida is about 900 days. Illinois is about 800 days. So it just takes a long time to get through this. What I was just talking about. So the timelines have extended, even in Texas, which is the shortest foreclosure timeline in the country, a state with a 21-day foreclosure cycle. It's taken about 6 months to do a foreclosure, just because of the way the regulations are and litigation rules are set up these days. So, shadow inventory. My definition of shadow inventory, and this is the stuff that you're going to be looking to come to market, is any property that's at least 60 days past due on a loan and not on the market, any property that's currently in foreclosure but not listed, and any REO, any bank-owned or lender-owned property that's also not listed. Those numbers have been coming down consistently, and we probably have about 1.8 million of those properties left in the pipeline, yet to come to market. The market is absorbing about 1 million of those properties a year between short sales, trustee sales, and REO sales. So we really have a backlog of about 2 years, 2.5 years of this shadow inventory, if you will, that's yet to come to market. One of the mystery factors here is the actual status and ultimate disposition of REO inventory, because we don't know what percentage of that REO inventory is basically just going to be bulldozed. There's a lot of properties that are on lenders' books right now that they can't sell, they can't give away, and they'll probably wind up donating back to metropolitan areas and donate some money to those metropolitan areas to fire up the bulldozers. See what's going on in Detroit, even Philadelphia, which has created a new land bank sort of greenfield project where they believe they're going to improve property values by knocking down properties. Yes, we have now come to a bizarro world. But about 1.8 million more of these properties to come to market over the next couple of years. Good news, as home prices go up, fewer properties are underwater. That means that fewer of those borrowers are likely to go into foreclosure. Good news for the housing market, good news for the economy, makes it a little rougher for investors looking for distressed properties that they can buy. What's really fascinating to me is just how few of the deeply underwater people, and that's what RealtyTrack's definition is, about 120% loan-to-value ratio, meaning that their loan is worth 20% more than the house is. Very, very few of them are actually delinquent or in foreclosure. So most of the people that are still upside down are actually making their payments on time. And because of that, we're not seeing a whole lot of churn in the marketplace. There is a rumor in D.C. that with Mel Watt's appointment as the head of the FHFA, we might see HARP 3.0. And what HARP 3.0 would be is an opportunity to expand that program to loans that aren't owned by Fannie and Freddie, so that private securitized loans to borrowers who in a lot of cases are still sitting with 10 or 11% interest rates will be able to refinance and take advantage of some of these new market rates. Now, what's interesting to me, just kind of theoretically, is what happens when everybody in the country has a loan that's less than 5% interest? Is anybody ever going to buy anything again? Or do we all stay put because we're looking? I mean, my interest rate adjusted this year, I'm down to 3.125%. So I got a note from my servicer saying, we're about to reset your rates, you know, batten down the hatches, put some money away just in case this is going to be bad. And my payments went down $200 a month. So am I in a hurry to run out and buy something? Probably not. So short sales and foreclosure sales, what you can see is that the blue bar there is trustee sales. We are actually starting to see more of these properties clear at trustee sales. Auction.com does trustee sales in about, I think, 15 different states right now. And we are seeing that the servicers, for the first time in years, are actually pricing these things to sell at the auction. For a while, they've been basically holding them back or overpricing them and repossessing them, but they are moving them. We're seeing short sales drop off a little bit. And REO sales actually spiked last year. I think a lot of that, though, did have to do with institutional investor activity. And whatever kind of distressed sales we're talking about, we're seeing that they make up less of the overall market than they did a couple years ago. I think they probably peaked between short sales and REO sales at somewhere around 35% nationally. Some markets like Las Vegas were 75% distressed sales for a while. Most recent numbers were somewhere between 16 and 19% of all real estate transactions on the residential side were some form of distressed sale. Historically, normally that number is less than 5%. So again, a lot better than we were, a lot less price pressure coming to market from those kinds of sales, but not anywhere near where we would be in a normal market. So what are some of the underlying issues that are keeping things from recovering even more quickly than they are? Biggest single issue is unemployment rates. I believe the unemployment rate improvement is a mirage. I hate to be terribly bearish about this, but when the unemployment rate improves because people are taking on part-time jobs or because people have voted themselves off the island and aren't looking for work anymore, I don't think that's really an improvement in the employment picture. And the two lines you see there are the lower line there is what's reported as the unemployment rate, and the bigger line there is sort of the underemployment rate. People who've been long-term unemployed or underemployed or have just stopped looking. So that's a real mess. One of the things I've tracked historically is that there's a direct correlation between unemployment rates and home purchase activity. And there's an inflection point somewhere around 6% unemployment where home purchases will go up or down depending on which way the employment numbers are playing. I'm not sure that's going to happen this time, again, because of some of the oddities in what we're reporting as unemployment numbers. Big problem is that the younger potential part of our labor force is unemployed at even higher rates. So if you look at that 25 to 35-year-old age cohort, there's a reason they're all still living with mom and dad playing Xbox in the basement. It's because the best they could do is find a part-time job at the local grocery store doing bagging, and they can't afford to support themselves, much less buy a house that way. So the first-time home buyer market segment is at the lowest it's been in the last 40 years. And the first-time home buyer segment is what juices the rest of the home buying segments. You can't sell that first house you bought unless there's somebody willing to buy it as their first house so you can move into your upgrade property. The other thing that's slowing things down is with junior living in the basement, mom and dad can't downsize. So all that discussion we heard about the boomers moving out of their properties to a smaller home have been delayed because the 25 to 35-year-old age cohort isn't moving out. The other directly related issue that comes into play here is student loan debt. So of all the categories of credit, the only one that grew last year from a volume standpoint was student loan debt. And it's basically kryptonite. You can't get away from it at all. So those supermen and superwomen coming out of college are really slowed down by this student loan, these toxic student loans that they're saddled with. I think the average for somebody who has a student loan is something like $25,000. Tough to get started, especially with some of these new rules where you have hard and fast debt-to-income ratios. If you start with $25,000 in debt, you're starting at a disadvantage. This is what I was talking about before, the labor force participation rate. So if you want to be smart and amaze your friends at cocktail parties, this is the one you want to watch. Not the unemployment rate, you want to watch the labor force participation rate. And again, we're at the lowest numbers we've been for a long time. I think we're down to about 62%, which is just unheard of. Most troubling in there is that we're short about 3 million jobs, 3 million participants in the 25 to 54 age cohort. That's peak earning years, and it's also peak home buying years. So that group is short about 3 million workers right now, which is a drag on the overall economy. Not surprisingly with all this, consumer confidence is running pretty weak. And if you're looking for an indication that the market's about to turn, look for consumer sentiment, look for consumer confidence, because people will not make a long-term financial commitment if they are basically pessimistic about where the economy is going. If they're not sure they're going to be able to get the job they need, if they're not sure they're going to have the flexibility to be able to handle what's necessary financially in a 30-year mortgage. So consumer sentiment is really weak. This is another one of those situations where the numbers are looking good, but they really should be up around the top of that level if we're looking at a robust, booming economy. And you can see that even with the recent increases, we have a ways to go. Consumer confidence is worse than consumer sentiment. I just got tired of throwing charts, so I thought I'd throw a cartoon up there. But basically, this is where we are. The consumer's still not coming out of his and her shell. And what I saw recently is that it looks like consumer spending has taken another dip. And in an economy that's 70% driven by consumer spending, that's another red flag to be watching. Not surprisingly, with all of this, we saw, and this was a disappointment to me last year. I really expected to see household formation increase significantly last year, and it didn't. For two reasons. One, we talked about quite a bit with the young folks staying home. The other is that we didn't see as much immigration as we expected in certain markets. So the two factors that would have created more household formation really were weaker than we expected over the last 3 quarters. Absent household formation, we're not going to see the housing market come roaring back. With a weak economy, we're not going to see household formation. So it's all connected together. And increasingly, when households are formed, the newly formed households are deciding to become renters rather than buyers. This, again, market opportunity for any of you out there who are in a buy and hold strategy. The numbers suggest already that in just about every market in the country, people would be better off financially buying than renting, but they've just either decided they're not ready to do that, or they can't afford the down payment, or they don't qualify for the new loans. So we're at one of those really odd points in our business cycles where technically people should be buying more than they are, but for a variety of reasons either can't or won't. And I believe, as I mentioned earlier, the home ownership rate will probably continue to drop. Now, let's keep this in perspective. Historically, home ownership rate's about 64%. If you go all the way back when they first started tracking it to today, the average is about 64%. Today, with all the drops we've had, it's about 64%. 70% is where we peaked. That's when we decided that everybody should get a mortgage. Turned out everybody was a bad idea. Some people just really weren't ready or financially capable of handling a mortgage, which is why we have these rules that I promise I'll talk to you about in a second. But we will probably continue to see this dip a little bit. I think it could go down as low as 62%, which would have people, gnashing their teeth and going to sackcloth and ash routines. But it might be a healthy correction for us to go through. A lot of the people buying houses today are investors. This is from Realty Track. That purple line there is institutional investors, and their definition is a little generous. They call anybody who buys more than 10 properties a year an institutional investor, but and we all know that's kind of light for an institutional investor. I saw the show of hands earlier how many of you are buying 10 properties or more a year. But the point is that the investor share of market is probably as high as it's been in at least recent history. So what does this mean for housing this year and beyond? I think 2014 is going to look a lot like 2013, probably somewhere between 4.9, 5.1 million units sold, probably about 1.25 foreclosure notices sent out, about 250,000 short sales, maybe 400,000 REO sales. Home prices will probably rise by 3 to 5%. And interest rates will probably stabilize, but not until they get to around 5.5%. Interest rates going up is one of the reasons I believe home prices will not continue to appreciate as rapidly as they were. And we will gradually get through the 2.5 million distressed loans that are already somewhere in the pipeline, the shadow inventory plus the other properties that are listed for sale but are still part of that delinquent group. We'll see foreclosure starts drop significantly next year. Short sales are going to begin to slow down even further as we get through 2014, primarily because as home prices go up, there's less of an incentive to do a short sale for both parties. And the numbers are going to return to normal, I believe, both in terms of the overall housing market and the distressed housing market by about 2016. Mortgage originations I talked about are going to drop probably from $1.75 trillion to about $1.1 trillion. Still a lot of money, still a big market, but a huge drop. Now, having said all this, 2014 is an election year, so Lord only knows what's going to happen in Washington that could screw all this up, but this is what theoretically I think should happen this year. So the 9 words that scare me the most that I'm going to talk to you about today are 9 words that just send a chill down my spine when I hear them in this order. And those 9 words are, we're from the government and we're here to help. And that's really what the Dodd-Frank bill was originally intended to be about, too big to fail. Remember how we had to bail the banks out in 2008? And this bill was going to fix that so we never had to do that again. And unfortunately, while there are a lot of good parts of the Dodd-Frank bill, the one thing they whiffed on completely was fixing the too big to fail problem. In fact, the cost of regulation has a lot of people in the industry saying the bill actually creates a new problem, which is called too small to survive. Because the cost of regulatory compliance and following these rules is so high that it really is a disadvantage for small and mid-sized originators and servicers. So we're already seeing a contraction in the industry, consolidation, people just getting out of the business. So that was an unintended consequence and in fact has kind of tilted the playing field so that the bigger financial institutions will probably wind up with a larger market share than they had when this discussion started. Having said that, let me talk to you about the 2 most important parts of the bill as it relates to the mortgage lending business. The first is the ability to repay rule. This we talked about a little bit before, but it is legislation that went into effect January 10th that requires lenders to make a good faith effort to ensure that a borrower will have the ability to repay the loan. Basically, there's 8 blocks up here. I got this from a website called Mortgage Dashboard, just because it's prettier than bullet points. But basically, this is good underwriting standards. This is what we used to do before 2005. We would make sure that the person was employed. We would make sure that the person, we would take a look at what the mortgage monthly payments would be. We would take a look at whether or not there were other mortgage payments. We would take a look at that person's debt, so we could then figure out what a debt-to-income ratio for that person might look like. We'd look at that person's credit history, and we would document all of this. And if all of those things met our standards, we might give that person a loan if the house looked like it was worth the amount of money that was being lent. Underwriters will tell you this is what they did for a living for about 100 years. Then we automated the process, sold all the loans to Wall Street, and bad things happened. So we've actually gone back to what looks like pretty standardized underwriting procedures. We've thrown in a couple twists. The maximum debt-to-income ratio can be no more than 43%. Okay, so no more than 43% of your monthly income can go toward housing. That eliminates 38% of minority borrowers across the country, right off the bat. And it eliminates countless more who are just sort of at the low end of the economic spectrum. And that's the group, honestly, that the CFPB was put in place to try and protect. And what they're actually kind of doing is making it more difficult for them to get loans. It gets into this, again, philosophical debate about whether that's a good thing or a bad thing, because if you're going to make it easy for somebody to get a loan who really can't afford to pay the loan, are you really doing that person a favor, or are you setting them up for failure? And so the CFPB has almost an impossible set of objectives. They have two parts of their mission. One is to make loans accessible. The other is to make them safe. The safer you make them, by definition, the less accessible they are. The more accessible you make them, the less safe they are. So it's a really interesting balancing act that they're trying to do. But these are the 8 criteria that the CFPB is requiring all lenders to put all loans through as part of the Dodd-Frank legislation. Now, the really, really good news for anybody here is that if you're doing hard money loans, if you're doing bridge loans, if you're doing anything that can be classified as a commercial loan, none of this applies. Okay? So you're not going to have Richard Cordray and the CFPB police come breaking down your door saying you issued a hard money loan to somebody and you didn't follow the QM rules. That doesn't exist. I will tell you, there is discussion in D.C. right now about whether they should allow for qualified mortgage rules for small lenders who issue below $2 billion a year of loans. And the language suspiciously looks like the kind of loans this industry actually does. That still hasn't been decided yet, so it's, write your congressman. But the thing about QM loans that nobody really talks about, and this is why it's a big deal, is if you issue a loan within the QM rules, as a lender, you can't be sued. Let me go back to my comment about Bizarro World earlier. Outside of the QM box, if you issue a loan as a lender and the borrower defaults, the borrower can now sue you. Think about that. You issue a loan, you lend somebody money, they default, and now they can sue you because their argument is you shouldn't have given me the loan in the first place. QM, if you follow all the rules, gives you what they refer to as safe harbor. So as a lender, I have now taken a look at the situation. I have determined reliably and in my best efforts that the borrower can repay the loan, and therefore I can't be sued. I can determine the borrower is a little higher risk, and so I'm going to increase the interest rate a little bit, and I'll be outside of the technical QM box, but I can still do that up to 1.5 points higher than the average interest rate and have something called rebuttable presumption, which means they can still sue me, but it's going to be harder for them to do because I've done all my homework. The real big deal about QM is that it protects lenders from getting sued frivolously from people who just decided they didn't want to pay their loans anymore. My speculation is that for the first part of this year at least, and we're already seeing this, the major banks are going to focus exclusively on issuing loans within that QM box. If you don't fit within the box, you're not going to get a loan, with one exception. If you're a high net worth individual with a ridiculously high FICO score who can put down a decent sized down payment on a property, you're going to get a jumbo loan from the lenders. So they will do non-QM loans to high net worth individuals on ultra qualified loans because they want those people for other banking services. And it makes a lot of sense. Wells Fargo had an announcement. They actually have what they're referring to as a SWAT team that's looking specifically at issuing and working on these kind of non-QM loans. And from a business perspective, again, it makes a lot of sense. Those are the only loans there's been a secondary market for the last year. And even those loans are having a hard time securitizing, but none of them are defaulting. I mean, their default rate is 0. unless somebody gets hit by a meteor on the way home, they're not missing a payment. So here are the other things to know about the QM rule. The monthly payments must be calculated on the highest payment that will apply in the first 5 years of the loan. So if it's an adjustable rate loan, what's the highest rate that might apply? That's where the borrower has to be able to pay the loan. And again, this came out of the lending practices in 04, 05, and 06, when the borrower was qualified on the lowest monthly payment, and when the rate adjusted, they defaulted. Monthly payments can't exceed the 43% back-end DTI ratio. I mentioned that. No negative amortization loans, which we should never give a normal consumer anyway. It's like giving a 4-year-old a bazooka and saying, have a good day. Just bad things are going to happen. No interest-only loans, no balloon payment loans. Now, there are some carve-outs, some exclusions. If you're in a rural area, if you're a rural bank, you can do certain kinds of balloon payments, but generally speaking, they're not allowed. There's no no-doc loans, no loans with terms longer than 30 years, no loans where the points and fees paid by the consumer can exceed 3% of the loan value. That, by the way, is a big sticking point for the industry and making life really difficult for mortgage brokers because of how they're defining those points and fees. No prepayment penalties. There's a requirement for lenders to retain the records for 3 years after the fact, so that if there are any questions about whether there was an ability to repay research done accurately, those records are available. That's generally what QM loans are all about. And I didn't spend a whole lot of time on the details because, as I mentioned, for this group, for this industry, for the most part, these rules really don't apply to what you do every day. Good for you to know about them. Good for you to know what the most likely outcomes are. There are probably going to be fewer borrowers qualifying for loans. The CFPB estimates that 92% of the loans issued in 2013 would qualify. That means that 8% wouldn't qualify. That means that 320,000 borrowers would not have gotten a loan this year compared to last year. What they didn't say was that of the 92% that do qualify, not all of them will get loans. Because even though they technically meet the requirements, there's no requirement for the lender to give them a loan. They might find something else they don't like about those borrowers, given the scrutiny that is going on right now. By the way, industry estimates are that more like 10 to 20% of the loans that were issued last year wouldn't qualify. So there's a lot of discussion about which loans really do and don't meet the criteria. The government footprint in lending is going to continue to be massive. The rules pretty much guarantee that Fannie, Freddie, and the FHA are going to continue to have 95% market share, because any loan that qualifies for FHA, Fannie, or Freddie automatically is a QM loan. It doesn't matter if you meet all the rules. As long as Fannie, Freddie will buy it or FHA will insure it, it gets stamped QM. And that also applies to refinance loans, so there's sort of a grandfather clause that exists there. Major banks, as I mentioned, are probably only going to focus on QM loans and prime jumbos. That's important in high-cost areas, particularly if we see Fannie and Freddie's loan level limits go down. So if you can only get a Fannie and Freddie loan up to $400,000 in California, that will buy you basically a shack. So anything above that is going to turn out to be a jumbo loan, really important. Interest rates will need to go up to entice private capital back into the market. We talked about that a little bit. As interest rates go up, I think you'll see people willing to take a little bit more risk, and private capital will be more inclined to come back and participate again. Until we get private capital back in the market, in two places, we're not going to see non-bank lenders come into the market. We need them into the market to serve the group that doesn't qualify for QM loans. We need private capital to come in and fund the loans in the first place, which they're not doing right now. And we need private capital to come back as a viable secondary market to buy these loans once they're originated in securities. Right now, it's a government game. We're not seeing any of that activity. Too risky and not lucrative enough for the private money to come back just yet. And then again, the non-bank lenders will eventually come back with non-agency loans when they can price the risk in to make it attractive enough for them to participate. I suspect we'll start to see that happen in the second half of this year, but the first half of this year is going to be really, really tough sledding for a lot of people trying to get loans. So what does that mean for you? Well, among other things, these rules are going to create headwinds for the housing market. which will probably slow the recovery down a little bit and make it difficult for borrowers who are on the margins to qualify for loans. I mentioned 38% of minority borrowers can't meet that DTI threshold. So it's going to be harder for people you would compete with for inventory to get the loans to buy the properties that they might be interested in and might otherwise be competing with you for. That means there's going to be attractive opportunities for cash or other non-traditionally financed purchases. So if we're still going to see 5 million homes sold this year, but if there's going to be 500,000 less mortgages issued, somebody's going to make up that slack. And my suspicion is it's going to be cash buyers, and it's going to be people taking out non-traditional financing in order to buy these properties. And then you saw, I saw that B2R was here today. So the institutional investors are now creating financing products that individual investors can use to actually buy and hold these properties. So we're seeing the market shift as part and parcel of what's going on overall. There's going to be a continuing market for rental properties due to the limited inventory and strong demand. Apartment units and multifamily units are rented out over 96% across the country. That's as high as it's ever been historically. So there's just not a lot available for rent. Possible opportunity to cash in or on the need for non-bank lending. If you're looking at lending yourself, just make sure you're working with an attorney to make sure you don't trip over any of the new guidelines. It shouldn't apply to most loans, but never hurts to be a little bit careful. And then the ongoing interest from institutional investors really does present an opportunity for buy and flip folks. We know a lot of the bigger investors who actually are working with small investors as local market experts. And they're moving out of markets they know really well. They're moving out of Southern California. They're moving out of Las Vegas. They're moving out of Phoenix. As they move into second-tier markets where they really don't have coverage, they're going to be looking for people who know the marketing and get them the kind of properties they're interested in buying. You can usually do that at a profit. So, having gone through all that, and with, I think about 5 minutes to spare, if anybody does have any questions, I'd be happy to field them right now. And again, if anybody would like a copy of the presentation, let me know, and I'll be happy to send it to you. I saw this hand first. You like me to talk about my auction business? Got to go on for hours. I really didn't come to do a commercial, but what I will say is auction.com, again, we sold about $8 billion last year in commercial and residential property. Most of the property on the website right now is distressed inventory. But there are a lot of people in this room, I imagine, who have bought a property or two on the website. Registration is free. You'll need a valid credit card to bid. We do hold funds if you're bidding. I think it's $2,000 or $2,500, which is released if you don't get the winning bid. But we get about 1.2 million people to the website every month. At any point in time, we'll have between 15 and 20,000 properties on the site. Numerically, most of them are residential, but we also have multifamily units. We have retail. We have light manufacturing. We have office complexes. I think the biggest sale we had this year was $70 million for an office complex in Glendale. So check out the site. If you have any questions, again, I can answer it afterwards, but I'd rather, I will not, the booth is gone, but I can stay for a couple minutes afterwards and chat. The young lady right behind you had a question.
Okay, on the HARP 3 product,
yes.
Did they decide to do something about the product that was sold during the housing decline, which was the first and second wraparound, because the HARP is only refinancing the first, leaving many people upside down with the second?
No, great question. Would the new HARP, if the new HARP product actually takes place, will it solve the first and second wraparound problem? No. They didn't solve it with HARP 1 or HARP 2 either. Seconds are still a problem. And there's no indication that it's a long shot they're going to do HARP 3. But if they do, I doubt they'll fundamentally change the program. The other thing you should know about the HARP program is they're very unlikely to extend the program in terms of the origination date of the loan. I think right now the cutoff is June 2009, and they're probably not going to extend that. That's already been announced. Other questions?
Anyone else? So if you do want to sell houses on auction.com, they will actually let you do that as well. And if any of you in this room would like help with that, you can reach out to me and I'll connect you with Lowell Santos at the auction.com headquarters. And he's the one that loads all of my properties for me whenever I'm selling.
And Tim's actually one of our best testimonials. He claims that he gets 15 to 20% more on properties when he sells them through the platform. You should know, as a seller, there's no charge. We do the marketing, we do the closing. There's no negotiating because it's a live auction, so they negotiate themselves. And we are actively looking for investors to work with this year, primarily because it's the next frontier for us. We started in distress space. We have a great track record selling REOs. We're selling trustee properties across the country. We're doing short sales and getting about 20% more than market offers on short sales. And we're doing well in commercial too. The last threshold for us really is to get into non-distressed properties. Properties have been fixed that are ready to sell, or they're rented out and ready to sell. And we believe the platform will deliver more money for you in those cases as well. But I try to tell our folks not to get too wrapped up in higher prices or lower prices. You can get good deals on auction.com, even though it's an active bid. The deal is, because it's an auction, it's generally the right price. It's the price a seller's comfortable selling for and a buyer's comfortable buying for. So one piece of advice I'll give you if you do start working on auction.com as a buyer or any other website that does auctions, have a number before you get started and stick to it. Because you do tend to get caught up in the excitement of the auction, even though it's online. And you've seen people go to ballroom auctions and they scratch their head and they wind up buying a picture. You do kind of get caught up in the emotion of the thing. So just have your plan before you get in there and stick to your guns.
Yeah, and I'm hyper competitive, so I don't bid. I mean,
you must win.
I would probably have to live in the house.
Only in America can the winner be the one paying the highest amount, right?
Yeah, right. And that is, even Chaz Carrier, he's the #1 home investors franchise in the nation. And last year, I think he bought 138 houses in Dallas last year, and he bought 15 or 20 off auction.com, because some of them you can find, and they're actually listed with a realtor, so you can go in and look at them. And I love the platform myself, and actually hope that we can get Rick and the team from auction at as many of these as possible. Any other questions? He's got to go hop back on a flight and go see his family and get his wife sick and pass the cold on.
There's one in the back, Tim. So I'll hang here for a couple minutes to collect cards and any questions about us. But actually, my email's up there. It's rsharga@auction.com.
So we're going to do one more question, and then we're going to let Rick leave because he has to catch on a flight, and then we're going to give away a TV, an iPad, and a bunch of money and stuff like that.
And by the way, if you're on it, you can follow me on Twitter. It's just @RickSharga. And I'm also on LinkedIn, and I'll post real estate information on there probably a few times a week. So if you're interested in this kind of stuff, check me out on LinkedIn or on Twitter as well. What was the question?
If you sell a property on your site, who selects the minimum bid? I mean, can you select a minimum amount that if it, so that you don't get lose your shorts over it or something?
That's a great question. Every auction that we do is called a reserve auction. So the seller sets a minimum price. If we don't hit that minimum price, you don't have to sell the property. Now, if somebody comes in at 95% of your offer, we'll call you and say, you want to do this? But that's how they all work. Great question.
Yeah, and it's fun. Well, sometimes, because you'll have a reserve set and your rep will call and say, hey, you've got 10 active bidders. You set your reserve at $90,000. I think your current bid's 85. I think if you let the reserve go, this thing's going to go haywire. And it's a gamble. Sometimes it goes haywire and sometimes there's not another bid. So I love that. I mean, because I'm a risk taker. My wife hates it because I'm a risk taker. So, all right, so give Rick a round of applause.
Thank you very much.